You spot a textbook bull flag forming on a 5-minute chart. You execute the long setup, place your stop below the consolidation, and immediately, price aggressively blows through your position. The setup looked perfect, but it failed because it was analyzed in a vacuum. Most retail traders examine lower timeframes in complete isolation, ignoring the broader structural landscape in closing their trades. True price reversals are never random. They are calculated reactions to massive, invisible supply and demand structures built on much higher timeframes. Look at this split-screen breakdown. On the left is the standard 5-minute pattern. On the right, we overlay the higher timeframe boundaries. The exact point where that lower timeframe pattern failed was a direct collision with a macro-structural ceiling. Surviving modern price action requires abandoning single-pattern chart reading. You have to analyze the market as a multidimensional, algorithmic environment. To navigate that environment, we use the DRW institutional Confluence engine. This is a complete, multi-layered algorithmic framework designed to track how large capital flows through the market. The underlying philosophy is simple. Trading is a rigid structural engineering problem. It is not a speculative game. You are mapping load-bearing walls and volatility limits. That philosophy dictates our foundational law, which we call the Golden Rule. The Golden Rule states that execution is strictly prohibited unless a structural equilibrium line perfectly intersects with a statistical volatility metric. A single standalone line on a chart is statistical noise. Institutional probability only exists at exact horizontal coordinates where multiple dimensions of structure and statistics converge. We construct the Confluence engine piece by piece, starting with multi-timeframe gravity. Higher timeframes act as the overarching structural boundaries holding the market together. They dictate the maximum limits of intraday expansion. Consequently, the lowest timeframe is strictly reserved for precision execution. You never use a 5-minute chart to determine macro direction. This diagram displays a 3-tier mapping of market gravity. The large 4-hour outer ring contains the 1-hour baseline, enclosing the rapid 5-minute core. The 4-hour timeframe tracks half-day swings and broader weekly liquidity. Moving inward, the 1-hour master baseline establishes active order blocks and the 50% mean threshold. If you execute trades without plotting these specific outer boundaries, you will inevitably be crushed by the invisible gravity pulling price toward them. Once the timeframe boundaries are set, we install dynamic moving averages. These function as internal structural scaffolding locked directly into the macro hierarchy. First is the 15-minute 8 EMA. This highly sensitive average tracks ultra-fast momentum, capturing the initial thrust of an aggressive trend run. Below that is the hourly 34 EMA. We refer to this as the chassis floor, the master structural baseline supporting any active trend. This chart highlights moving averages acting as structural floors. Look at the thick hourly 34 EMA providing a rigid foundation underneath advancing price action. We then add the hourly 55 EMA. It aligns perfectly with the 1-hour 50% midline, creating the final deep mitigation reload zone. To complete the scaffolding, we apply hourly Keltner channels to map the dynamic expansion and exhaustion boundaries surrounding the trend path. Combined, these specific exponential moving averages provide the exact mathematical scaffolding required to safely frame violent intraday volatility. Shifting from dynamic to horizontal structure, we have to distinguish between active, newly formed order blocks and historical midlines. A newly formed order block tells you when a move is initiating and dictates the immediate directional bias. But the true C50% midline is the exact historical center of a previous order block, and it serves a completely different function. These historical midlines identify the permanent geographic coordinates where massive, passive institutional limit orders are resting. This isolates an order block formation. We pinpoint the exact 50% midpoint, projecting a yellow horizontal line into future price data. Days later, price drops onto this projected line, absorbs the impact, and immediately bounces upward. That line functions as a liquidity shelf. Multi-day algorithmic models park capital at these exact coordinates to defend their average cost basis. However, if intense volume aggressively breaks that support midline, a polarity shift occurs. The broken support immediately flips into an overhead supply ceiling. Institutional algorithms do not chase momentum breakouts. They patiently wait at these historical equilibrium thresholds to passively absorb incoming retail flow. We now introduce the statistical component of the engine, daily quant standard deviations. High probability execution requires identifying the exact moment a structural true C midline lands perfectly on top of a statistical quant boundary. This four-quadrant matrix classifies convergences when a 50% midline overlaps daily quant labels. In the L1, L2 reversal floor quadrant, downside expansion stalls, yielding an asymmetric long setup. In the CMID quadrant, daily statistical volatility perfectly overlaps the structural midline on the exact same mathematical axis. Securing this mathematical overlap fulfills the strict requirement of the golden rule, completely eliminating subjective guessing from your trade selection. With multiple levels on the chart, you need a precise method to organize dense, overlapping data points without cluttering your execution screen. We use strict criteria for construction. If a true C midline and a macro anchor exist within a tight 2 to 8 tick radius, they are combined. As seen here, we take those two parallel lines, capture the tiny gap between them, and enclose them into a single unified container called the golden zone box. To populate these levels accurately, apply strict session filtering. Use 1-hour charts across all trading hours to capture overnight algorithmic order flow. Conversely, isolate pure cash market swings by locking 2-hour charts strictly to regular trading hours. This removes thin overnight distortion from your multi-day structure. Constructing a golden zone box cleanses your execution chart of noise, distilling multiple chaotic timeframes down into one undeniable zone of engagement. Once price finally enters your constructed golden zone box, we transition into the micro-execution phase. At this stage, your execution is governed strictly by the physical anatomy of a 5-minute candlestick. You must explicitly differentiate the behavior of a wick piercing a boundary versus a solid body closing against it. This sequence details the valid entry. The 5-minute candlestick drops into the box, pierces the bottom edge with a wick, but closes its solid body inside. This swing failure pattern confirms institutional limits just absorbed the selling pressure. Conversely, if a 5-minute solid body confirms a close entirely outside the box, it signifies a structural breakdown. The trade is immediately invalidated. Macro forces build the containment box, but microscopic candle anatomy is the only valid trigger to initiate capital deployment. Upon entry, you deploy immediate risk calibration, an approach known as balanced stop mode. You place a hard stop loss exactly 2 buffer ticks outside the opposite boundary of the golden zone box. This map visualizes the math. Entry occurs inside the box, risk is capped below, and upside trajectory plots sequentially. Secure initial profits at 1R, hold the core position for quant resistance, and trail runners to outer Keltner bands. Every piece of this engine exists to align multiple timeframes, dynamic averages, historical limits, and daily volatility into one exact point in space. Structure creates the playing field. Statistics set the outer boundaries. Confirmed closes trigger the execution. Wait for perfect convergence and trade the matrix.